Be Wealthy and Smart, episode 1268.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to discuss that last week was the best week for stocks this year. It's so exciting because if you remember back on October 13th, I posted a buy signal on the podcast. Then on October 30th, I said, is there a year-end rally ahead? And on November 1st, I said, NASDAQ is ready to take off. And that's exactly what's been going on. Last week was the best week for the S&P 500 and the NASDAQ for an entire year. Not only that, but prior to last week, the Dow Jones Industrial Average was down 0.63 for the year, and last week alone, the Dow was up 5.07%. That's pretty incredible. The S&P 500 last week was up 5.85%, and the NASDAQ was up 6.61%. Again, those two indexes had the best performance in the last year just last week. And prior to the S&P being up 5.85% last week, it was up 8.67% for the entire year. So if you were out in cash last week, you missed spectacular returns, which is why we always say we want to be long-term investors and not try and time the market. Because if you miss just 1 week like last week, you're missing out on almost an entire year's returns. Now, telling you basically 3 times that the market was ready to take off, I feel really good about that buy signal back on 1013, even though it was a little bit early. That's okay. I didn't say it was the all-time bottom, but I did say we have a strong rally coming, not only last week, not only coming up through the end of the year, but into the first half of next year, we're going to see an incredibly strong rally that is going to shock a lot of people. Why? Because many people are still incredibly bearish, and the pessimism and the fear is incredibly high. And when people are fearful, that's when markets take off. It's when we're off the charts on the other side, on the greed side of the sentiment chart, that's when markets can have sharp pullbacks. But we are nowhere near that. We are on the fear side, and this market looks poised to continue to take off. So even though we had a strong week last week, is that it? Is it over? Oh, heck no. We are going to have a very strong November and December, in my opinion. And that is also going to carry over into next year, where January is going to be strong into the first half of next year. That also means the IPO market is going to have a chance to come back strong. And I think technology stocks are going to lead the way. Now, what is causing all of this, and what caused last week in particular to be up so strong? There were 2 main things, in my opinion. First was a soft jobs report, which drove bond yields lower. And when bond yields are going lower, it's signaling that interest rates aren't going higher. They're going to continue to trend lower. And that's what I believe we're going to continue to see. Although many people are still saying they think the Fed is going to increase rates in December, but as I told you last podcast, there's only a 14% chance of an interest rate hike in December, according to the futures markets. And even though the Fed has been jawboning about higher for longer, the bond market is telling us something different. And stocks follow the bond market, especially if it differs from what the Fed's rhetoric is. So the October jobs report came in on Friday, which was weaker than expected. And it showed that lag time I've been telling you about, that it takes over a year for some of these numbers to come down when the Fed has raised interest rates. We're starting to see the economy cooling and the inflation coming down. Last month, the U.S. economy added 150,000 jobs, which was less than the 170,000 payrolls increase consensus estimate that Dow Jones had. And it was also lower than September's huge number of 297,000 jobs added. So the unemployment rate rose to 3.9% compared to expectations that it would stay at 3.8%. Also, average hourly earnings didn't go up as much. They rose 0.2% in October, which was below the 0.3% estimated increase. So bond yields have been super strong for the last 3 months, but they tumbled on Friday because of the softer than expected payrolls number and the lighter average hourly earnings increase. So yields on the 10-year Treasury lost more than 0.09%. to 4.57%, down from the 5% high in the last month. And the 2-year Treasury yield lost 0.13% to 4.8%. Now also, we had the leading stock, Apple, fall by 0.5% after they reported a weak revenue outlook for the December quarter. Of course, Apple is heavily weighted in the indexes, and so just a small decline in Apple does impact the market. But the market was so strong that those powerful performance numbers were not impacted by Apple's decline. And Apple wasn't the reason for the big performance boost last week, which is good because just 7 stocks have been dominating most of the performance in the entire stock market. What this says is that interest rates are likely to be trending lower because we can see that the economy is cooling, the jobs market is weaker. This is what the Fed's been waiting for. And as I've said over the last several months, the Fed is data dependent. They look at the numbers and that's how they make decisions. So when you get weaker employment numbers or lower inflation numbers, interest rates normally will start to decline, and that will lead stocks higher. Because what the stock market is saying is there's a very good chance that the Fed is done raising interest rates, which was the title of my last podcast. I do believe the Fed is finished. They're not going to be able to raise interest rates anymore. We've seen the peak in rates, and that's why the stock market is going to drive performance much higher. Combine that with the short covering that has to occur because there's too many hedge funds that are short out there. They have to buy. That's strong buying from hedge funds. We're going to have the window dressing from the professional money managers and mutual funds who have to go in and buy stocks so it looks like they've been in stocks all year when they've been actually very bearish, and they've been in bonds and they've been in cash. You've got the year-end portfolio buying, and you probably have buy signals triggered from this exceptional performance. So this market is poised to take off. And if you're still sitting on the sidelines in cash and you're a long-term investor, this would be a great time to get back into the market because the next 8 months look to be exceptionally strong. And you definitely don't want to miss out on that performance. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.